Okay, moving right along. So I said before, we understand since the inception of the fund that people that have invested through us educate your clients about the level of volatility that your client will sustain over the medium to long term in a fund like this, notwithstanding that the performance long term is fine. The problem is we've identified two major concerns that advisors have and underlying clients also have with regards to investing with us. And this is why we are embarking on a journey to try to reduce the volatility of clients' exposure with us. To A, if you're sitting on the borderline of whether or not you want to put money with us, this might tip you over the line. Two, if you currently have exposures with us, it might make you feel more comfortable to maintain those exposures or increase it slightly because the risk tolerance that we're going to adjust the fund to will be something that's far more palatable to something like Australian equities. We've identified two things. Firstly, volatility sits at 21 to 22% per annum since inception. Number two, when we divide all the clients in history investing with us, divided by the time that they've been invested with us, the average return is terrible. Now, this is not the first time that you've heard this. This is across all active management, and everyone has seen this in some way, shape, or form. Morningstar has done research on this, and a whole lot of other consultants have done the same thing. So what we realized is, because of the sheer volatility of our strategies, we found that people are entering in at the worst time and getting out at the worst time too, marring their experience of investing in our funds. The reality of the Australian financial advice world is that 90% of you that sit here in this room today do not operate an MDA model. Which means that even if today you decide to say, I believe in the story, I'm going to allocate X% of my clients' money to Premium China, for example, your clients won't be fully deployed till July 2017. That is where the issue lies here. What we're trying to do is reduce volatility. I want to make very clear what we're doing here is not capital protection. We all knew what capital protection meant after the GFC. It didn't protect your client's capital, it protected the issuer's money. And that's a very, very different equation. With anything with regards to volatility management, what we're trying to do is that the sword will cut both ways. You will gain less on the way up, you will lose far less on the way down. But it works, and I'll show you why. This is the volatility of the China Fund, month on month since inception. This is the volatility with MMRS. Now, how does this program work? In simple terms, if the volatility of the fund heightens and it's going in the negative direction, Milliman will subjectively, based on their algorithm, will sell market futures that are linked with what we're invested in. So at the moment, 60 to 70% of the fund is invested in Hong Kong. Therefore, when the market takes a dive, they will start selling Hang Seng futures, start selling HSCEI futures, and will start selling MSCI China futures. When the volatility starts subsiding, they will sell less. That's what I mean by this cuts both ways. The back testing is acceptable because it is subjective in nature. So dependent on where our asset allocation is at the end of each day, Milliman, based on their model, would determine how much market futures they're selling in. On top of that, they are creating a 5-year daily rolling put option to reduce volatility further. This is the most simple way that I can explain the strategy to you. As I said before, there are 10 retail funds available in the market that already have this deployed. Each of us deploy it for very, very different reasons, but it's deployed in the same way. It is a volatility management strategy. Each fund manager that deploys this chooses a level of standard deviation. And overall, when both the put options are put into play and selling of market futures, we are aiming a targeted volatility of around 15%, which is around Australian equities. So how does this look like since the inception of the fund? I showed you the volatility. This is the performance of the fund since inception. So you put in $1 million back in 2005, you'll end up with about $2.4 million today. This is the net equity exposure, representing, as you can see, as a simple example, in January 2009, at the worst point in the GFC, they were effectively selling us completely out of the market. In reality, what occurs, the blue line you see at the bottom there is the collateral that Milliman takes out of your client's fund to pay for those market futures. So once we activate this strategy, $95 will go into the fund and $5 will go to Milliman to pay for these futures. This does not affect the liquidity of the fund. This does not affect Alan's management of the fund. And it reduces the concerns of those two issues that I said, both regards to volatility and timing. After all is said and done, this is the return profile of the China fund afterwards. It doesn't look like there's a massive difference long term, right? But the short-term gyrations are significantly reduced when you look at the numbers play out. The total return of the fund, and this is ending March 2016, is 8.94 after fees per annum. With MMRS, it is 9.44. The cost of MMRS to the fund is 25 basis points. As opposed to the other managers in the market, we have decided to absorb the full 25 basis points and give it to you for free. We do not intend on opening up a new fund. We unfortunately are not the likes of some other institutional managers. We cannot afford to open up a separate unit trust. So we are just going to overlay it over this fund. So in actual fact, instead of the 50 basis point difference you see between the fund and MMRS, it will be about 75 basis points better off per year, where the volatility has dropped from 21.5% to 14.5%. Now remember that I said that the sword cuts both ways. When the level of volatility in the world is quite low, and when I mean volatility, I mean positive volatility on the upside, in 2006 you can see the difference is 6%. In 2007, when the market was going nuts, the difference is about 16, but on the way down, instead of losing 35, they would have lost 18. And in the recent heightened part of the crisis, instead of losing 13 for the first 3 months of this calendar year, they would have dropped 7. And that means that you can explain, you have less to explain to your clients about. Now, I don't mean that in a bad way. I mean that you're not going to get those panicked phone calls. Now, I want you to take note of 2015 though. In 2015, the fund did positive 5 and MMRS did positive 15. Why is that? In the first half of the year, the market skyrocketed. The second half of the year, the market tanked. As the market tanked, based on the algorithm, they started selling market futures, defending the returns that was already made in the first half of the 2015 calendar year. So this works, but we're not going to put it on now. For the reasons that you heard from Alan and Yan, we are at the bottom of a cycle. Why would we want to put it on at the bottom of a cycle? I have not received a single piece of feedback from advisors across the country I have presented this to, and it's been about 100 advisors across the country. Not a single one has said, Jonathan, this is not a fantastic idea, because I need to explain less to my clients, but I still want your fund because it works. If I show you a second most volatile time period of the fund's history, we see a slightly different outcome. I'm building here a since inception till the end of the first bull market rally in 2009. So we have a bull, followed by a bear, followed by another bull. This is the net equity position. This is the collateral. This is the outcome. In dollar terms, 19.69% versus 18.62%. So if the level of volatility is shockingly high, as you can see here, this was the highest period we could find. We wanted to find the worst period of volatility, and it hit 23.3%. There is a slightly inferior return. So I'm giving you the best of both cases. In the long term, it washes out. In the long term, because the underlying volatility of the fund is high, this works. The more volatile the fund is, the better this system works. And at 15% volatility, you can accept that. And I can accept that as an advisor as well. You're going to get a copy of all these slides and me repeating this to you again over a webcast. If you have any questions, please feel free to ask me. If I can't answer the question, we will divert the question to Milliman too. Asia. A couple of countries that I want to talk about in focus today and things that we're interested in. First one, South Korea. As you know, this is the outside of the Greater China region. This is our largest exposure. From a macro standpoint, South Korea has nothing exciting going for it. From GDP growth to consumer spending is all somewhere between 2 to 3%. The South Korean government have always come with a rhetoric at the beginning of the year and saying we're aiming for 3% growth, and as the year progresses, they keep decreasing what they expect it to be. The good thing is, just like most other nations across the world at the moment, inflation is sub 1%. What we're investing in is things like Samsung Electronics. Now, we exited that position quite a while ago. We're starting to enter it now. And here's world irony at its best. Who is Samsung Electronics' largest competitor in the smartphone race? Apple. Now, what's happening is that this year or next month, when the launch of the iPhone 7 comes around, it will be utilizing Samsung 3D NAND chips. Those memory chips that you see when you go to Telstra and ask them, do you want the 32 gig version or the 64 or the 128 gigabyte version? They are using Samsung NAND. And to make things even more interesting, in the 2017 year, when they launched the iPhone 7S or the iPhone 8, depending on what they want to call it, they'll be utilizing Samsung OLED screens. Because Samsung is the only producer of OLED screens at a scalable level and highly profitable. So all of a sudden, Samsung Electronics as a play has become a proxy for the future likelihood of Apple as well. Now, the other key interesting point that we hold in South Korea are things like Korea Electric. So a utility. The reason why we like to hold utilities in places like Korea, Korean electricity tariffs are the lowest in the OECD. And they're only going to go upwards. And the dividend yield on Korea Electric is already very strong. The third part of the story is exposure of preference shares, which is something we've talked about since 3 years ago when we started entering the South Korean market. This was the way for the Korean economy to control the capital inflow in and out of its country. It would issue preference shares for you to draw money in, but not give you any voting rights. And these preference shares 3 years ago were trading at a discount of up to 70% to their ordinary shares. Today, they trade at somewhere between a 20 and a 30% discount. But we still like buying them because there's upside on the closure of the gap, arbitrage gap between pref and ordinary. And on top of that, you get the same dollar dividend, which means the dividend yield is 20 or 30% higher under the pref share. So Samsung Electronics, as an example, all of the shares we hold in electronics is pref. The second story is Taiwan. Taiwan, as most of you know, is an IT-linked society and an IT manufacturer, where the largest company in Taiwan is TSMC, or the Taiwanese Semiconductor Manufacturing Corp, and that is a holding in our fund. Now, what's interesting about Taiwan is that some people were concerned about whether or not, after the latest round of presidential elections, if the cross-strait relationship between China and Taiwan was going to diminish, and it didn't. It's not progressing at a particularly fast rate, but the good thing is it is not backtracking. So for people who believe that China and Taiwan are going to be in a war and the US Navy is going to deploy more aircraft carriers in the strait in between, that's not going to happen. The thing with the Taiwanese market is there's significant inflows into that market now, stronger than China and stronger than Hong Kong. And the market, year to date, is up 8%. Performance since the May inauguration is 20%. And the dividend yield is the highest in the region at about 4%. And that's high for Asia, as we all know. The third country is Singapore. We only hold about 6% of the portfolio there. There's nothing exciting in Singapore. We hold a REIT, we hold a supermarket, and we hold DBS Bank. That's it. We'd rather actually buy Hong Kong, which I'm now going to talk about, instead of buying even something like Singapore. This is the performance of the fund, and what's interesting to note, this fund now has a 6-year track record. The volatility of this fund is low compared to the China fund. It's at about 13.3%. So if you want an undiluted Asia exposure, but it is a diluted China exposure, then this fund is an option to you. And this one has annualized net of all fees at 10% per annum since 2009. And as you can see, that is our current distribution between the countries. We profess we don't invest in countries we don't specialize in, and we hope also other fund managers don't invest in countries they don't specialize in. So this is an ex-Japan, ex-India fund. We're currently contemplating what our exposure point and how do we specialize in getting into the India market. These are our top 10. The slight difference I can say between Alan's thinking and Renee's thinking as the two PMs of our two respective broadside equity funds is that Renee is investing in larger blue chip companies. As you can see, they do hold Tencent as well. They hold Largan, she holds Largan Precision, which is actually the competitor to Sunny Optical. They hold Gree Electronic Appliances, which is the world's largest air conditioning manufacturer. Korea Electric Power, which I explained before. Café de Coral, which I'm about to talk about. And also Kwai Chow Mao Tai. This is Chinese white wine, not Chardonnay, but Absinthe. 50–60% alcohol. Now, for those of you that have been to Hong Kong, you know how crowded the streets are. If you're searching for food in Hong Kong, you don't go past the ground floor. In the last 3 to 5 years, what we have seen is that there is a massive influx of mainland Chinese tourists into Hong Kong, buying up all the Rolexes, the Guccis, the LVs, the Salvatore Ferragamo shoes. That's what we've been seeing. But in the last 2 years, as the anti-corruption campaign has hit, coupled with the fact that the middle-class spending power of China is increasing, but the high-end spending is reducing, and a lot of the high-end people are now going to Japan, to the disgust of the Japanese population, given the history, but they want to make money, and that's the reality. Café de Coral is a QSR, a quick service restaurant. This is the equivalent of Asian McDonald's, but it's not what you think it is. For those of you that go to Chinatown, we as Asians love comfort food, and our version of comfort food is something like this. Soy chicken, roast duck, cut up, put into a box with a bit of rice, a bit of vegetables, and off you go. You know why they're all hanging there? Because it's easy to prepare and easy to serve it up to you. It takes 2 minutes. So in Hong Kong, a lot of people, as part of their lunch, nice and cheap, they'll buy what we call rice box, and that's exactly what it is. Café de Coral was started in 1968, and that's exactly what they are. They're a quick service restaurant. But over the course of the decades, they started going into Western food lines as well, including pizza, as well as Spaghetti House. And I quite enjoy Spaghetti House whenever I'm in Hong Kong. They were listed in the late 1980s, and this is one of those companies that just have year in, year out, very predictable, certain earnings. So you can see the ROE on the right-hand side. Last 2 years, this year, and 2 years are forecasted. It's very, very stock standard. Pays a 3 to 3.5% dividend yield, but here's why we want to buy it now. Remember I talked about the high-end retail? All the high-end retail are now in Japan. And places like LV and Gucci are closing their flagship stores in Hong Kong, being replaced with flagship Adidas stores, flagship Nike stores in places like Causeway Bay, Central, and Admiralty. And Cafe de Coral now has a prime opportunity to be able to rent ground floor space as opposed to renting the first floor or the second floor. Because people aren't going to go to the second floor for QSR. They want to hit the ground floor running, and Cafe de Coral now has a better opportunity to do so. Second story, South Korea. Anyone heard of this company before? Besides the name Samsung? Samsung has over 30 listed entities in South Korea. Hyundai has more than 15 listed entities in South Korea, ranging from funds management to insurance to electronics to cars. Samsung covers the entire food chain and supply chain. But Samsung Fire and Marine is a very interesting case. In Korea, the insurance market is very, very regulated, so premiums are kept under control. But the medical costs in Korea are going up faster than the premiums are. Now, as you know, with all insurance companies across the world, there are only two ways for you to make money. You make money from underwriting, or you make money from investment profit. And in Korea, it is very difficult to make money from underwriting profit. Now, Samsung Fire and Marine have taken a different approach. And what they have done is that they've entered the car insurance market back in 2009. But they do it via the internet. And what they found out, as a simple example, though it may sound ironic to us, that 26-year-old young ladies who buy car insurance over the internet drive very slowly and therefore have a very low chance of being involved in a high-speed accident. Because they've created it so easy for people to buy insurance online, they have had a plethora of applications, which has led them to have a 28% market share from a 0 market share in 2009. It has also meant that they've become very picky with their clients because they now have a better data set for the actuaries to work on to price premiums. If you have a highly regulated premium price and you can corner the conservative end of the market, you make money, right? So when you look at this, Samsung Fire and Marine in history has had the lowest underwriting loss. You're talking about a meaningful difference of someone like Samsung having an underwriting loss of 77.5% versus Hyundai, which has an underwriting loss of 93%. This is where the growth is. These are those very specific stories that we spend a lot of time on, and we have a Korean fund manager and a Korean analyst within the Asian team. The fixed income conundrum. This is the list of alternatives you have for your clients. BlackRock last week made a very interesting point, which I've shared in every single meeting or presentation I've done this week. If you have strict definitions for each of the asset classes you invest for your clients, you are missing the bigger picture. At the end of the day, your clients don't care how much you put into each type of asset class. They want to know what the best opportunity set is. And that got me thinking. In 2 meetings we had here yesterday in Melbourne with researchers, they said, Jonathan, why don't we think about it this way? How about if we take your fixed income strategy and we put it in the equity pool? Anyone thought about that? Because here's the question. If everyone in the fixed income space is generating something like 4.5% for you, for your clients, when you take away your 0.8 or 100 basis point advice fee, and then take away another 60 or 70 basis points from the platform fee, what are you giving your client? you're giving your client heightened risk with the term deposit return. And so advisors are taking two different angles. They're either finding the lowest cost option, or they're saying to the client, you know what? If you want to give me $1 million to invest, give me 700 grand, take the 30 grand, play into a term deposit, and I'll invest 100% of the 700 grand you give me in growth assets. And that's a viable way to go too. And that's something that's getting people to think. Because infrastructure, as we all know, even for our firm, we've invested all we can into infrastructure. And the yields were great. The yields are now lower because the capital value has increased. Inflation-linked bonds in a world where there's no inflation, investment-grade bonds where there's not enough spread for anyone to justify their own existence, and cash and hards funds you may use because you need to fund a client's pension account. But other than that, what options do you have? With that, I want to introduce our third fund manager for 5 minutes over a video. His name is Gordon Ip. He is the head of fixed income for Value Partners, and he's going to talk you through what we invest in that region.
Hi, I'm Gordon Ip, Head of Fixed Income at Value Partners. Just a little bit of introduction of myself. I have been with Value Partners since 2009, and I have more than 15 years of investment experience in the global fixed income market, ranging from interest rates, credits, as well as securitized products. The fixed income here at Value Partners consists of 9 investment professionals covering the entire Asian credit space, including Japan, Middle East, and the Commonwealth independent states, particularly Russia. Driven by investor desire for yield and our ability to provide unique products that satisfy those needs, we have seen substantial growth in our fixed income business over the past few years. Currently, our team is managing more than $2 billion of fixed income assets for our clients. Our investment philosophy is very simple. Actually, our name says it all. We are value-oriented fixed income manager, and our job is to find value in the global credit space through our rigorous process of bottom-up credit analysis. Our process is both quantitative and qualitative. First, for each mandate, there's usually a certain return or yield target. We scan our investment universe against this yield target to arrive at a smaller set of bonds that are candidates for inclusion into the portfolio. For those that are screened out, we will keep monitoring. But for those that are screened in, we will conduct rigorous credit analysis in which the issuer's credit and liquidity profiles, their business models and industry outlook, their financial statement, their management quality and track record, as well as relative valuation versus the peers, will be going through full evaluation in our intensive process. For those that have passed our stringent requirements will end up in our portfolio, and those positions will be monitored and evaluated on a continuous basis. Lastly, as we are an integrated team of both fixed income and equity professionals, the synergy between both teams really gives us better breadth and faster execution of ideas than many of our peers. We think Asian debt is attractive. From a fundamental perspective, implied default rates of many Asian issuers are being priced too bearishly, which don't even link close to reality. And distortion in the market are there for those who want to find them. From a technical perspective, Asian debts are primarily owned by Asian investors who are very familiar with their own issuers, which make them more steady hand of bonds. Therefore, Asian bond markets often tend to be more resilient than some of the developed markets. In fact, the stable performance of Asian debt markets amid the recent Brexit event provides a very good example of how resilient these markets are. We are very happy with the performance of the Premium Asian Income Fund. Since inception, we have been able to deliver our investors strong income of minimum 6% per annum with low volatility, and we have never missed a distribution. On a total return basis, we have achieved an annualized return of 11%, with a volatility of 5.9% since inception, achieving a Sharpe ratio of roughly 1.8 times. This performance is a direct result of our rigorous credit selection process and also prudent currency management. Special situation refers to an investment strategy in which an investor will try to profit from a unique situation or event faced by a company. Those situations include, but not limited to, merger and acquisitions, refinancing, litigation, asset sales or liquidation, etc. This strategy requires extremely intensive analysis and close monitoring. However, if the situation works out to investor favor, these are highly profitable trades. We have been running a small percentage of the fund in special situation strategy, and it has been quite profitable. When there are opportunities, there are also risks involved. On opportunities, Asian credits, especially China property credits, offer good risk-adjusted value compared to credits in developed markets. Limited supply of bonds and ever-increasing demand for yield provide very supportive environment for Asian credits. A continuous low global rate environment also favors fixed income investment, especially high-yielding assets. On risk, investors should be mindful of more aggressive Fed rate hike and the development in Europe following the recent Brexit event. In addition, investors should also pay attention to any idiosyncratic credit events in their portfolio.
So a couple of key takeaways from Gordon's video that I want to explain. First of all, which part of the market do you want to play in? This is the capital structure of any investment across bond to equity. There is no spread available from senior secured debt. You're taking enough equity risk, and have you bought enough hybrids yet? That's my baseline question to everyone in this room. If you buy hybrids, have you bought enough yet? Do you realize that it has an equity-like risk? And your clients most probably don't understand that risk. We are only interested in senior unsecured debt in this portfolio. This is a legal definition. What we're doing here is dialing down significant risk in your fixed income portfolio for your clients going forward while generating a yield that is acceptable by both you and your clients net of all fees. This fund was launched in August 2011, and at the end of this month, we will have a full 5-year track record, which everyone knows is the magical time period for any fund. The $19 million you see there as the fund, it's almost hitting $20 million today. This is the highest level of investment we have invested in our own funds. We charge a basis point management fee of 98, plus a performance fee and a hurdle rate of RBA plus 2% with a high watermark. It's continental Asia, Middle East, and now includes from the 1st of July, Commonwealth independent states like Russia and Kazakhstan. We pay quarterly distributions in this fund, never missed a beat, and every distribution has been at least 150 points per quarter. Now, since everyone is fee conscious in this day and age, since the 1st of July, we have killed the performance fee. This is the only product in our suite which does not charge a performance fee, because we believe under the fixed income, we need to give you as much value add as possible. In total return numbers, the performance fee has cost investors an extra 100 points per annum over the last 5 years. So we're removing that in totality to charge a flat 98. This is the implied default rate that Gordon was talking about. The blue bar that you see there is representative of the range of the different pricing that the bonds are sitting at. So meaning, the closer that line gets up to 100, there is more bonds in that marketplace that is trading at an almost 100% chance of default. Whereas the number that you see in yellow represents the average of that. So if we look at China, double B rated bonds, the market is implying 27% of that market will default. Note, ladies and gentlemen, that our fund has weathered the storm of 2013 and 2014, where there were emerging market debt routes, in which the reality and the implied default rate are so far different and removed from each other. I also want to make notice to the Philippines part of the market, you see there's no rating next to the country name. Now, why is that? Because in the Philippines, no one believes what the research house says and doesn't need a research rating to buy the bond. Irony at its finest. So where we add the value and why you pay us 98 basis points to give you value add to your clients is because we do not care about the rating of the bond. Hand on heart, how many of you look at the rating of a bond by a major research house and consider that as gospel as to whether or not your client has capital security? We don't. We have 9 investment professionals, including 2 dedicated dealers split between Hong Kong and Singapore, that manages the $2.5 billion of fixed income assets for value partners. And Gordon sits here at the top of that chain, and he started with the firm when they incepted their fixed income strategies in 2009. Gordon specializes in the portfolio management as well as high yield. These 2 gentlemen focus on financials as well as investment grade debt. This fund contains very little investment grade debt, and it is effectively 90% high yield, of which 80% is sub-investment grade by a debt rating perspective. The beauty of it is that if I ask you this question, if you're happy to buy the equity of a business today, why are you not happy to buy the bond of the same business if it's paying the right coupon? And this is how the 58 team members with our investment team interact with each other to find the best ideas for your clients. Gordon in 2015 was ranked number 7 out of 500 investors in Asia, and they won Fund of the Year Awards Outstanding Achiever in the high yield space in 2015. Gordon is an incredibly kind-hearted person, and besides what you saw in the video, he does smile, unlike most other bond managers in the world. As of 48 hours ago, we have received our new endorsement by SQM Research with a 4-star superior rating on the fund, which has been upgraded from 3.75 stars in 2015. This is a result of performance as well as us increasing our investable universe as well as increasing the total return to your client by removing the performance fee in its entirety. The total return of the fund, as Gordon mentioned, is 11% per annum net of all fees and 5.8% volatility, which makes this fund have a Sharpe ratio of 1.8. I want you to reflect upon the client portfolios you build today and find out how many funds have a Sharpe ratio of 1.8 times. As I said, we pay quarterly distributions out on this fund because the cash yield is 8.6%. Meaning it is very, very easy for us to pay at least 150 basis points to your clients per quarter. In the financial year that just passed, ending 30 June, we paid a total yield or distribution to your clients of around 8%. The yield to maturity of the portfolio is 9.7, which represents that on average, the 49 bonds we hold in the portfolio are trading below the $100 par value. That means that we can get capital gains for your clients on bonds. In a way, you can think that that is a bit of insurance. Secondly, BlackRock also mentioned the other week that people are now buying equities for income and buying bonds for capital gains. How odd the world has become. The time to maturity on the portfolio is 6.3 with the modified duration at 3. Everyone's looking for low duration, so we're providing it. High yield, low volatility, low capital movements, strong income, low duration, with a manageable portfolio of 49 securities. The country allocation, 55% to China and Hong Kong. We try to invest as little as possible in Indonesia because it's an overcrowded trade. Western fund managers that buy into Asian debt go through Indonesia because they think it's a better market, it's less distorted, because China, as we mentioned, is highly inefficient, just like their equity side. And 45% of our exposure is in real estate. 19% of the bonds we buy aren't rated. 55% are B and below. Remember what I said, we do not care what the credit rating is of a bond is, because we can add a lot more value there. So, the two questions that come out of here, because those two stick out like a sore thumb, let's discuss it. Why China? It's a function of the credit market. Most of the Asian credit market is China. 2, people rush to Indonesia instead and overcrowd the trade. Therefore, we'll buy, as you all know in the last 2 decades, we buy stuff that other people don't want to look at. And thirdly, because people don't look at it, you saw the implied default rates allowing us to buy a discount to region. Then your second question would be, why property, Jonathan? We keep talking about property and property blowing up in China, and Yan has shared her views on the situation. So why property? Function of the Asian credit market. 2/3 of the bonds in Asia are property. We have 45% exposure. Is that so unreasonable? Second, it's a simple business and transparent data. Yan and her team have access to clean data through the Bloomberg of China called WIND. And that gives all the property sales data, project data, one after another, in a clean manner for us to evaluate. And thirdly, as Gordon always says, at the end of the day, if your bond was to default, would you rather be holding to property in a piece of land, or would you be rather holding a bag of fish? Non-perishable inventory is very important to us, which gives us a large safety net. These are all very measured and deliberate moves to create a portfolio that can generate true returns to your clients. We surveyed 100 advisors that have never heard of the word premium. And we asked them, what do you invest in for fixed income for your clients? And this was the outcome. I'm not picking on any fund manager here. I'm just surveying the market, and this is the risk and return profile for 5 years. Now, I've asked advisors, I take a guess that in the next 5 years, all the dots you see on this page, including ours, will move to the right and down, representing a heightened level of volatility with a total return lowered. If that is the case, which part of the risk spectrum do you want to take for your clients? And the question that I asked before, would you consider this as part of the growth portion of your client portfolio? There are 3 strategies that are available in Australian dollar terms that buy emerging market debt. Again, these are not available to you anyway, but I want to show you the danger of buying emerging market debt. I've painted you a really rosy picture, but I will paint to you what the danger is. If you're buying US dollar debt without properly hedging your position back in Australian dollars, you'll get a return like this with Goldman's, like this with Lazard, and like this with PIMCO. All 3 of these funds are emerging market debt funds. And it's not because they have poor security selection. The reason is because they don't hedge anything back to the AUD and get trashed. What we do in our portfolio to reduce the volatility to your client is that we actively hedge the AUD against our exposures in USD. Every single bond we buy is not listed on an exchange or a stock exchange. It is listed on Euroclear, which is the highly liquid global marketplace for bonds, which is multiples times size larger than the equity market. And what we do here is that we found that over the course of the last 20 years, we find a very high correlation between the Australian dollar and the JP Morgan Asia Credit Index, and a very high correlation between the Australian dollar and the economic performance of the Chinese economy. So what happens is that when there's heightened risk in the region and mark-to-market risk hits the overall portfolio of bonds, we're already unhedged. By being unhedged, we take the hit on the mark-to-market, we make money by being unhedged as the Australian dollar tanks in the same direction. And that's the correlation I'm talking about. This is how we generate 5.8% volatility to your clients. There's no secret behind it. We're talking correlation here. We never say we can pick active currency. We're saying we're picking based on a path-dependent correlation. And the last 5 years, with 2 liquidity impacts on the Asian credit space, we have done exceptionally well. So what we have is that we have a portfolio that is well diversified, not the type of portfolio that you saw before GFC, where bond managers were holding 500 corporate bonds, and that's what I call blind man diversification. This fund doesn't have leverage. It's not something strange that you've never seen before. It is a straight bond fund. Our duration is lower than our time to maturity. Our cash yield is lower than the yield to maturity. And we actively hedge the Australian dollar to reduce your client's exposed volatility risk, mark to market and currency side. This fund currently sits on Macquarie Wrap, it sits on BT Wrap, and it sits on Hub24. The next step that we will aim to go to, since we now have a 4-star rating, we will now go to Net Wealth to have it added on there as well, but the fund needs to have $25 million. We have on the feedback forms written a section asking you if you're interested in this fund as well as what platform you use, because we'd like to touch base with you. We have received exceptional support in the last 2 months as we've gone to market properly with this fund, and we'd like to help you too with your fixed income exposure. Now, that's all we have time for today.